All right, let's move right on then and connect with Steve Englander, who of Standard Chartered Bank, who's joining in. Thanks so much, Steve, for taking time out. And, as we were discussing earlier, while the expectation is largely on the fact that the central bank is going to hold rates back in the US, do you think that the focus is largely going to be on the summary of the kind of economic projections as well that we get down the line?
I think that's very much the case. If you take a look at what's expected for the next couple of meetings, they haven't really moved very much. And as you said, there's like zero priced in for tomorrow. No one expects any kind of move. But what you're seeing is 2-year yields, 5-year yields hitting cycle highs. If you go out the curve, say to January 2025, expected Fed funds is hitting a cycle high. So I think the market is focused on what's going to happen down the road. And we think that they're going to keep a hike in 2023. And we think that they're going to take away one of the cuts in 2024. It's a signal that they haven't yet seen the economy slow down enough to justify sort of as aggressive cuts as they had last time.
My question, sir, is if Fed is unlikely to move, which seems to be the consensus, then why are bond yields spiking up? Why is the dollar index marching higher?
That's the $64,000 question. I think that we had been expecting the U.S. economy to show more signs of slowing. It really hasn't. The data are mixed, and whereas last year you had some bad GDP data, but the labor market was firm. This year, the labor market looks a little bit soft, but some of the other indicators are looking more firm. And so I think the market is saying that the Fed is not going to feel any compulsion to cut rates. And, some of the low inflation numbers, I think they're worried that they're coming from special factors and that the slow inflation may last 6 months further. But ultimately could be a little bit transitory, and that there are concerns about inflation further down the road, and there are concerns about the deficit further down the road.
Do you expect a sell-off in the bond market, a further spike in the dollar index, given where commodity prices are moving?
Well, there are two factors. One is tomorrow we expect the Fed to sound a little bit hawkish. We expect them to sound a little bit hawkish, not at all like the ECB last week. It's also, just technically in the market, the momentum seems to be in favor of higher yields, and nothing seems to be stopping it. And what we've seen a couple of times is that you go into the Fed meeting, and as long as there are no big surprises, as soon as it becomes clear that there are no big surprises, the momentum trade continues. So, we could see a little bit higher yields as a consequence. We don't expect a big announcement, but the market sure seems to want to sell bonds in the short term here.
Right. Okay, Steve, great to have you on the show. Thank you so much for taking the time out and joining in today. Let's move